Today, on A Recession Doorstep. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, a broad sell-off sent US stocks reeling on Tuesday after a hotter-than-expected inflation report dashed hopes that the Federal Reserve could relent and scale back its policy tightening in the coming months. This, of course, is the last inflation report before the Fed's policy meeting next week. Some investors had hoped that the Fed would have some reason to raise rates less dramatically, but the Fed is determined to squash inflation despite the risk of pushing the economy into a recession, and Tuesday's report dampens hopes that inflation has already peaked. Financial markets have already priced in an interest rate hike of 75 basis points at the conclusion of the FOMC's policy meeting next week, with a 33% probability of a supersized full percentage point increase to the Fed funds rate. The central bank's target range is currently 2.25 to 2.5%. In a note following the August CPI data, Goldman Sachs sees a more aggressive Federal Reserve. We've raised our forecast for the Fed's December meeting to a 50 basis point rate hike versus 25 basis points previously, and we now expect a 75 basis point hike in September, followed by a 50 basis point hike in November and December, which would take the fund rate to 4 to 4.25% by the end of the year. And so, with hopes of a Fed pivot firmly dashed, all three major US stock indices veered sharply lower, snapping four-day winning streaks and notching their biggest one-day percentage drops since June 2020 during the throes of the COVID-19 pandemic. And the VIX rose more than 14% to 27.27. The sell-off is not a surprise given the rally running up to the data, said Paul Nolte, portfolio manager at Kingsview Asset Management in Chicago. The report points to a very persistent inflation, and that means the Fed is going to remain engaged and raise rates. And he added, that's an anathema to equities. The Fed's increased interest rates by 3 full percentage points in the last 6 months. We have not yet felt the full impact of all those increases, but we will feel it. We are at recession's doorstep. Worries persist that a prolonged period of policy tightening from the Fed could tip the economy over the brink into recession, and the inversion of the yields on the 2- and 10-year Treasury yields, regarded as a red flag of impending recession, widened further. The US dollar rose in a flight to quality. Gold eased. Labour Department data showed on Tuesday that the US consumer prices were boiling last month, dashing hopes of a nascent slowdown and likely assuring another historically large interest rate hike from the Fed. The consumer price index decreased 0.1% from July after no change in the prior month. From a year earlier, prices climbed 8.3%, a slight deacceleration largely due to recent declines in gasoline prices, but significantly the so-called core CPI, which strips out the more volatile food and energy components, rose 0.6% from July, and that's 6.3% from a year ago, the first acceleration in 6 months on an annual basis. All measures came in above forecasts. Shelter, food and medical care were among the largest contributors to the price growth. The acceleration in inflation points to a stubbornly high cost of living for Americans, despite some relief at the gas pump. Price pressures are still historically elevated and widespread, pointing to a long road ahead towards the Fed's inflation target. Remember that Chair Jerome Powell last week said that the central bank will act forthrightly to achieve price stability, and some policymakers voiced support for another 75 basis point rate hike. Officials have said their decision next week will be based on the totality of the economic data that they have to hand, which illustrates a strong labour market and weakening consumer spending. Traders boosted bets that the Fed will raise interest rates by 0.75 of a percentage point, which now seems to be an outcome that's locked in. If there was any doubt about that, 75, they're definitely going 75 at next week's Federal Open Market Committee, said Jay Bryson, chief economist at Wells Fargo. We thought they'd be stepping it back to 50 in November. At this point, you'd say 75 is certainly on the table in November. The partials show that food costs increased 11.4% from a year ago. That's the most since 1979. Electricity prices rose 15.8% from 2021, the most since 1981. Gasoline prices, meanwhile, did fall, down 10.6% in August. That's the biggest monthly drop in more than 2 years. But shelter costs, which are the biggest services component and makes up about a third of the overall CPI index, continues to rise. Overall shelter costs increased 0.7% from July and 6.2% from a year ago, both the most since the early 1990s. Excluding food and energy, the cost of goods was up 0.5% from a month ago, while services costs, less energy, climbed to 0.6%. Economists have been expecting goods prices to cool as pent-up demand leads consumers to shift more of their spending towards travel and entertainment, but both remain elevated. Used car prices fell for a second month. Airfares also dropped, likely due to the declines in fuel prices. Non-prescription drugs, though, rose the most on record on an annual basis. Overall, medical care goods posted the largest advance since 2017. As far as health services, health insurance surged a record 24.3% year over year. And this rate of inflation continues to erode Americans' wage gains. A separate report on Tuesday showed that real average hourly earnings fell 2.8% in August from a year earlier, continuing a steady string of declines since last April. On a monthly basis, however, real wages did grow for a second month. The underlying point is that wages have now become the top driver of inflation. And with Fed officials already highly concerned about a potential wage price spiral, the central bank is likely to keep hiking into the first half of 2023. Now, all of this, of course, has political implications because persistently high inflation has dragged down President Joe Biden's approval ratings and threatened Democrats' chances of retaining their congressional majorities in November's midterm elections. Biden, in a White House ceremony on Tuesday, argued that he and his fellow Democrats have helped steer the economy back to firmer footings as they tout a sweeping new climate, energy and healthcare law dubbed the Inflation Reduction Act. Bit of spin there, I think. The markets reacted as expected, with the Dow Jones Industrial Average down 3.94% to 31,104. The S&P 500 lost 117 points, or 4.32%, to 3,932, and the Nasdaq Composite dropped 5.16% to 11,633. All major sectors of the S&P 500 ended the session deep in red territory. Communication services, consumer discretionary, and tech shares all fell more than 5%, while the tech subset semiconductor sector sank 6.2%. Surging risk-off sentiment pulled every major sector deep into negative territory, with interest rate-sensitive tech and tech-adjacent market leaders, led by Apple, Microsoft, and Amazon, weighing heaviest. Although Twitter actually went up slightly because shareholders voted to approve the $44 billion takeover from Elon Musk. Twitter rose 0.8% on Tuesday. Now, elsewhere, European natural gas prices did ease, with politicians scrambling to fix the deepening energy crisis after Moscow switched off its main pipeline to the continent. Benchmark futures fell as much as 4% after surging on Monday. Russia's decision not to resume supply through Nord Stream after it was shut down last week for maintenance has forced European governments to plan market interventions, including price caps and windfall taxes on profits of energy companies. They're trying to avoid blackouts and to protect the regional economy that's already on the brink of recession. While gas storage sites are being filled quicker than expected, concerns remain over how Europe will replace lost supplies from Russia when it gets cold and demand rises. Germany is unlikely to meet its target for filling inventories to 95% by the start of November. European Union energy ministers are set to meet on Friday, and the proposals on the table so far include power demand curbs, measures to boost liquidity in the sector as collateral demand skyrocket, and a price cap on gas. The UK's incoming Prime Minister Liz Truss has drafted plans to freeze energy bills for households. And Germany plans to keep 2 nuclear plants available this winter, while Chancellor Olaf Scholz and French President Emmanuel Macron agreed to help each other ahead of the EU talks this week, with Macron pledging to ship gas to Germany if necessary. As traders weighed the intervention plans, And also gas demand is as yet still relatively low before the heating season starts. So maybe Russia has played the potential hand too soon, as we're still not in the colder months, said Nick Campbell, the director at Inspired plc. With gas stockpiles still rising and all the moves that Europe's governments are planning, shutting Nord Stream, supplies through which had been slashed even before the halt, perhaps is not the death blow that the Russian state felt it would be. And finally, Fitch Solutions has downgraded its short-term iron ore price forecast as demand weakness and tight energy markets, which are expected to continue into 2023, have ended the high price environment experienced in the first half of this year. The firm now expects iron ore prices to average $115 a tonne in 2022, down from a previous forecast of $130. Although prices have averaged $121 a tonne to date, Fitch noted that iron ore was trading in the range of $95 to $105 a tonne, and inventories in mainland China had recovered from their lows in June. So the firm expects that prices at current levels have limited further downside. Miners are already beginning to react to recent price declines, given their operating costs and capital expenditure costs remain elevated, it said. As such, we believe that prices will receive some support from supply constraints through the fourth quarter and into 2023, as higher cost miners have in several instances reduced production in response to current price levels. However, upside is also limited by the recovery in inventories over the summer and synchronized slowdowns in growth across major economies. This increases the likelihood that inventory levels maintain their recent gains or rise further as buyers take advantage of lower prices. So Fitch Solutions forecast iron ore prices to average $100 a tonne in 2023, $90 a tonne in 2024, and $80 a tonne in 2025. So all of this has significant and profound impacts on the Australian economy. Of course, the markets opened lower and will continue, I think, to grind sideways or lower through the day. But more broadly, lower iron ore prices means the terms of trade are going to be badly impacted. And of course, broader consumer sentiment is also pretty weak. And with higher interest rates now expected in the US, it's hard to see our interest rates here in Australia staying as low as many expected. So my expectation is that we are going to see higher interest rates here in Australia, which will flow through here into higher mortgage prices, which will put downward pressure on the property sector. And bearing in mind the way our economy works, those commodity prices will also have a very significant and negative impact. So the question now becomes, will Australia manage to hang on and not slide into recession when the US follows maybe the UK and the Eurozone? Or will we also go the same way? Too soon to say, but what you can bet on at the moment are lower equity prices ahead, as higher interest rates are going to really grind markets considerably lower. And I'll remind you again, September and October are the months in the year when predominantly markets head south. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.